Moving ahead, our first panel discussion is on the topic managing balance sheets in changing geopolitical environment. For that, I invite our moderator, Ms. Latha Venkatesh, Executive Director, CNBC TV 18, and our panelists, Mr. Rajiv Anand, Senior Vice President, Bombay Chamber, and Deputy Managing Director, Axis Bank, and Co-Chair, BFSI Committee, Mr. R. Govindan, Senior Vice President, Corporate Finance, and Chief Risk Officer, L&T, Mr. Amit Agarwal, President and Head, Private Credit, Edelweiss Alternatives, Mr. Rakesh Singh, MD and CEO, Aditya Birla Finance Limited, and Mr. Rajiv Sabharwal, MD and CEO, Tata Capital, and member, BFSI Committee, Bombay Chamber. With the panel discussion, there is an announcement to make. It is a privilege to announce that the Bombay Chamber is organizing a webinar on post-budget discussion on Union Budget for financial year 2025-26 in February 2025. The details regarding the webinar will be shared on Bombay Chamber's website soon. We look forward to the participation of all of you over there. Thank you so much
for organizing this conclave and for a very topical selection of issues. We had two excellent presentations, so it's easy handover from there to what we are discussing. But I'm going to indulge in a minor subterfuge. With the permission of the Senior Vice President of Bombay Chamber of Commerce, Rajiv Anand, the overall theme of this conclave is role of credit in a $5 trillion economy. And the subtopic given to us, to this panel, is managing balance sheets given the new geopolitical developments. We're going to walk freely between the two issues, the major topic and the minor topic, because I have an elite panel over here, and I want the best conclusions or the best observations that they have of their sector to be presented to this audience. We are not going to bind ourselves only to geopolitical questions, but to the broader issue that faces credit. Geopolitics is an important issue that is crimping or fashioning credit decisions, but it is not the only one. So pardon our indiscipline. The intention is that the best comes out from the panel. But let me start being faithful to the issue as to what has geopolitics done to the management of balance sheets. Jan 20th, the new president will be sworn in the United States, and it's going to overturn a lot of expectations. We were expecting that everyone will vouch for lower tariffs so that everyone benefits, specialization, division of labor. That whole logic is going to turn on its head. So, if Rajiv Anand is giving credit, if Govindan is borrowing for, hedging on commodities for L&T, all these decisions are going to get impacted by the industry. So let me first start over there, Mr. Govindan. How will this coming era of geopolitics, actually it's already hit us. We already went through a Ukraine and we already went through a red hot war in the Red Sea. But we're going to far more challenging times where you may have to buy solar panels. You don't know whether it should be 25 cents, 18 cents, or 10 cents. We don't know what the tariff is going to be. So how do you approach? What kind of hedging instruments do you have at all?
Yeah, you can hear. See, I think that from whatever experience I have faced as a part of finance, managing the balance sheet for the group, the toughest period was 2008-9, right? And the second has been, I don't know whether 2008-9 was tougher or 2020-21, that COVID. See, 2 years of COVID plus a war created complete chaos. And if you have to say what it meant to, let's say, construction business, or any business which has got some long-term orientation. Steel, just to give an example, was what, $35,000 bucks ton in 2019. We were in a bottom, we were just slowing down at that point of time. 35,000, 38,000. And you work on projects and you bid for projects. You assume maybe it will be around 40,000 tons, 40,000 bucks, or 45,000 over a 3-4 year timeline. And you have a 4-year cycle. Usually these projects take 4-5 years. And it is true for many institutions. There are institutions who have long-term business cycle, 4-5 year cycles, 10 years, 5 year cycles. There are consumer companies and retail companies who got shorter timelines, right? You don't have that. It goes ups and down pretty quickly. This sense of this COVID and a war immediately, it is like a horrible combination which doesn't happen. Maybe it's a 1 and 2, 300 year cycles. It doesn't happen like that. If you look at the prices, I told you 35,000. The thing went to 20,000, 22,000 in a COVID period. You couldn't have bought and sold anything. Oil was even negative price at that point of time, right? You couldn't have done much. 2 years have gone wasted. And then you have a Ukraine war continuously, right? And you have 75,000, 80,000 rupees as done. So that was a very tough period for anybody who's a long term. So the producers suffer significantly during COVID period. And they have a super good time in 2022 end and onwards. So many of these things have still the impact of all of that is not yet gone through. Meaning it's still, I think the profitability not only of banks, except that's a magnificent 7. Almost every industry is going through this margin compression cycle. I don't think there's any industry in the world where margins are sort of, other than the magnificent 7, which is the tech companies. This pressure is there across every companies. But you need, I think could you have predicted a situation like this will happen, right? And that is a skill which you need to have as a large institution, whether a crisis will happen or not. 2008, it was predictable. It was predictable in the way 2007 you had that 2008.
And the bubble will burst.
Bubble will burst. So you really have to have equity, long-term capital and stuff like that and risk framework on the liability side to ensure you are able to pass through a significant thing. This was a lot tougher. This period, 2020 to 22, that was a lot tougher. Still many industries are still going through the difficulties. It has not come out. If you look at offshore wind, right? People signed up PPAs in 2019 at, let us say, $2, or let us say it will Indianize the whole thing. It is like 2 rupees or 3 rupees per unit. And the prices come down. I think she talked about the module prices. Some 25 cents, came down to 15, went up to 40 during the war period, now down to 9 cents, right? So when you have a long-term arrangement, if you had already tied up the whole thing, it is okay. But if you have not tied up, and when you have to work with the government, so you work with the government, say 2 rupees, you tied up the tariff. Cost of projects have gone up by 70-80% post-COVID environment. Now, you have to renegotiation, all sorts of things happen. So these sort of periods are very tough periods. If you can navigate, you need to keep businesses simple. Not take too much
keep inventory periods short, is it?
Yeah, you have to keep that and risk. Whoever is the best institution to manage the risk will have to manage the risk. You don't take risk. If you are see, banks can take credit risk. They're in their job. In a company, you don't do credit risk at all. I mean, you don't invest, let us say, less than AAA rated bonds or in a government. You don't go beyond because don't add to the problems. So you have to make it in that sort of scenario. And if you look at all of this, Trump coming in, I think we will be able to manage. I think it's a lot.
If you can manage COVID, you can manage Trump.
Yeah, it's a slightly easier problem is what I feel.
Okay. Well, actually, that's an encouraging and optimistic start. I'm throwing pessimistic questions not because I'm pessimistic, but because I'm hoping that you will quell the pessimism of these questions. Rajiv, on your point, sorry, Rajiv Anand first. If you can tell us whether, banks are prepared for the climate risk that you are getting to. I'm coming to the trade risk as well. But climate risk is all over the place. I mean, we already saw microfinance, for instance, the bad loans were to some extent because of extreme heat, inability to collect money, or inability of the borrowers to go out and work. So is climate risk, are you all mapping it? Certain areas which are more seismic prone or more, wet area prone, flooding prone. Has the banking industry started off on any kind of mapping of climate risk?
I think the point that you make about climate risk is absolutely valid. Um, are banks well prepared to manage climate risk in the context of credit risk? My answer is certainly not. And I think, all banks are at various levels of preparedness. But I think what I would certainly like to leave on the table is that the fact that there is climate risk, or the fact that you've got to think through in terms of climate risk as you do credit proposals, not just on the corporate side, but increasingly on the retail side, is now well understood. And so therefore, it is embedded into our, philosophies, into our, policies, etc. But do we have adequate understanding to be able to make the right calls on this? I think weather patterns itself has become, the point that Govindan was making, weather patterns itself have become, so volatile. What was weather patterns for the last 100 years have changed over the last 5 years.
I heard that State Bank has attempted a mapping of India in terms of vulnerable areas. They have some kind. So I'm just asking if every bank has
banks have various levels of sophistication. I mean, I do know that State Bank has done some really good work, but various banks have various levels of sophistication, around this. But it's an evolving space.
Fair point. Now, let me come to both the geopolitical and the credit risk to Rajiv Sabharwal. Rajiv, map the macros for us. From what Mr. Vishwanathan and Joydeep Sengupta told us, it appears that we are in a slightly negative scenario for credit because growth appears to be faltering in large economies. Certainly it's faltering in Europe and China. But even in India, what we thought was a God-given right to 7% now looks extremely shaky. Not just in the quarter gone by where we got 5.4, but even in the coming quarters, the figures are looking wobbly, more like 6.3, 6.4. And inflation, even globally, appears to be headed higher, partly due to tariffs, partly due to climate, partly due to geopolitics. So, how do you see credit evolving?
I completely agree. The first two presentations were very informative. However, I was going to tell Joydeep, what he said in terms of compression of margins globally is definitely not visible in India. So Indian market has distinctly behaved different than the global market. And you would see the performance in terms of stock markets also. How India has behaved in some of the other economies and how India and US has behaved vis-a-vis the other economies. And this is purely because growth is visible in US and India. And there are a number of factors which have led to this growth. I do believe banks in India have been far more sane than banks in other places. Our regulator has been far more sane than what we have seen elsewhere. I think the banks in India are far more resilient than what we have seen in other economies. So to that extent, I would say India is different than the others. As far as credit is concerned, a lot of times we just criticize ourselves too much. A growth rate of 6.5%, 99% of the world will die to get this growth rate. I'm not saying we should be happy with 6.5%. I think we all know the reasons why it has become 6.5%. We are waiting for government capex as well as private capex to come back and less of doles and more of investments to happen. But I do believe that we can be easily in a stable range of about 7.5% growth rate, which would mean credit growing at 12 to 14%, which is very good. I think what is more important, is the fact that we should have strong institutions which should allow for that credit to get disseminated pan-India and not be limited to certain segments or to certain markets. Luckily for us, there is fair amount of competition in India which allows for this to happen. So I'm really not so much worried about the 2 to 3% slowdown in credit, because I genuinely felt that, in the last couple of years, maybe consumption credit grew at a significantly faster pace than investment credit, which is good, but we have to decide how much is good. So a little bit of moderation on consumption credit, but for the investment credit to hold would be better for the Indian economy.
Well, that's throwing up a lot of issues which I'll toss to them, but just a matter of numbers. India's Nifty returned 8% in 2024. NASDAQ returned, the US indexes returned approximately 20%. In India, the Nifty Bank returned 4% last year. So the pressure was there on margins already. And even in the US, the Magnificent Seven returned 63%. So there, 20% also is,
Latha,
it didn't come to the financial sector, is my point.
Only thing which I am seeing is, do look at it over a 2 or 3 year period rather than a single year. Because if you use a single year, the previous year will look obnoxiously good, which is again not right. Because we know what led to
the
this,
cycles.
and we are paying the price of that. The moderation of that, we are paying the price of it. So I think we need to look at a 3 year period, and we need to, like when we get worried about low growth rates, low, 6.5 we are calling low, but low growth rates, we should also be worried when credit grows at a high pace. So both of them are important for us to
paid the price for the 25% credit growth as well. I take your point completely. And each of these, as you say, is a theme in itself, and we can't do full justice to it. But just one point before I come to the other two guests. Rajiv, Anand, Rajiv Sabharwal raised this issue of, everybody went into consumer credit a bit too much. How is this going to get resolved? Because as Vishwanathan's pie chart showed us, industrial credit grew 5%. Retail credit grew 23%, sir. That was your pie chart in terms of incremental credit last year. Now, look at how things have evolved. I think there is a natural fear for bankers after the AQR and the 10 lakh crore of loans that had to be written off over the last 4-5 years. There is a fear to tread in terms of corporate credit, you want to be sure. And on the other hand, not just one, at that time we used to think about probably, HDFC and maybe a little bit of ICICI in retail. Now all the public sector banks are only in retail. And then there is fintech. And then there is the rising army of NBFCs armed with better, AI lending. Everybody and their uncle is in retail. Do you see this getting resolved? I don't see private capex really growing much beyond that 5% which was there in Vishwanathan's pie chart. Immediately, is this getting resolved? Is there going to be an overkill in retail leading to bad loans and not enough private capex and credit?
So I think first and foremost, I think one has to look at the credit costs that you're talking about in the context of the fact that credit, just to the same point that Rajiv was making, if you look back over the last 3 to 5 years, credit costs for banks have been at record low levels. So those credit costs have moved from those record low levels to somewhat higher levels. Right, and so, therefore, it is not as alarming as one is making.
Not at all alarming.
Banks continue to be, to the point once again that Rajiv made. NIMs continue to be strong. ROAs continue to be strong, ROEs, continue to be strong. So let's ensure that we are looking at that, from that perspective. The question that you're asking on corporate India.
How do you get out? Do you see capex?
See, I think over a period of time, we will get to a more balanced growth. Remember that corporate India today is in the best position that we have seen in a decade. They're all generating huge amounts of cash. Govindan never wants money from me. You talked about the fact that, we should be lending to L&T. But corporate India, I mean, not just the very large corporates, but even
We are
mid
in the
corporates are generating.
2004 period, when Rakesh Mohan would call it lazy banking.
So
You are
therefore,
not
to that
lending.
extent, I mean, corporates don't want money. I mean, and so then the question to ask is, given where capacity utilizations are today, why are they not expanding capacities? I mean, why is L&T's order books not increasing significantly more than what we are seeing today? And that's a question that we should certainly ask, and that's a question which is critical as we think about sustainability of the 6.5% as we go forward.
So you think that the growth logic will itself correct the over-lending to retail?
It already has. I mean, I think, to some degree, because of the tightening underwriting standards, because of the push, from the regulator as well, and I think we should certainly commend the regulator for seeing this, sooner than later. You already have seen unsecured loan growth has significantly slowed within the economy.
Yes, certainly. Now let me come.
Can I add just one point to it? When I do believe that within retail credit also there are a lot of sectors which should continue to do well, whether it's housing, whether it's set of MSMEs, small MSMEs, and so on. It is the unsecured bit which needed a moderation, which in a way it's good it has happened. And just one more point. I think when we talk about the impact of what's happening globally and the challenges relating to rupee-dollar rate, challenges relating to interest rate, swap costs, and so on and so forth, I think what is very important is for us to take advantage of the tailwind which we have of getting Make in India work much faster than the way it is. The government has done many things, but I think still some more reforms which the government is aware of will help this process. The faster we do it, a lot of these problems will automatically get resolved, whether it's in terms of employment, whether it's less spent on imports, more exports, and so on and so forth.
No, I'll come to that in terms of what suggestions, the low-hanging fruits in terms of policy emphasis. But Rakesh, the big segment again in Mr. Vishwanathan's pie chart, which seems to be doing reasonably well, is MSME credit. Now that's a very big positive if we can continue that momentum. But you tell me, how do you all manage? How are, for that matter, MSMEs managing? What would be currency risk, commodity risk? Are they able to tide over this?
Yeah, so Latha, we heard the corporate lending growing at 5% and consumer at 23%. If you look at the MSME has done really well over the last 4-5 years. If you look at almost 15.5%, 16% growth rate. And it's quite stable. The portfolio also post-COVID has come out and it's quite stable at this point in time. And that's a big driver for any economy. And so is it for India. So if you look at India, 30% of the GDP contribution comes from MSME. If you compare that to most of the global economies, it's around 50% contribution comes from MSME. And the government wants to drive that quite significantly in terms of, because if you look at post-digitization and post-implementation of GST, if you look at, we have close to around 63-64 million micro SMEs which we have in the country. Out of that, 3.3 crores is Udyam registered. And now GST registered is 1.2 million. All these customers and these MSMEs have a lot more data which banks can use from an assessment point of view, underwriting point of view to really, so the access to formal credit which was not available to this segment is now gradually moving up. And it's, so there was in 2017, there was a 70% credit gap to the MSMEs. Now it's come down to 50%. So I think with the formalization of economy, the MSME sector, which is, and also another positive part of the MSME sector is they're very nimble, very agile. So your question in terms of, yes, inflation, crude prices and all, but they're very nimble, very agile. And lot of them are in the trading business. They manage their inventory well. They manage their input cost well. Yes, if the cost goes up and the rupee, you said. So the export MSMEs will do well. You will have to manage the import. You will have to diversify your supplies. And you have to really manage that well. And that segment manages it quite well. So very nimble, very agile. Cost, in terms of managing the cost, we have seen it. And even if you look at during COVID, when things were looking at so uncertain, this sector really managed it quite well. So very, very positive in terms of, and we really focus on this sector quite a lot. Almost 55-60% of our loan book is to the MSMEs. And how do we really onboard them, underwrite them? I think that's the challenge which all the lending institutions is. But with digitization, with all the GST returns in terms of your ONDC, OCAN, there are a lot of initiatives which government is taking, the DPIs and all. I think it's improving every day and every year. So I think that's a big growth driver, the way I see it.
Well, I have some counter questions on that, but let me get first thoughts from Amit as well, and then pour my doubts over MSME credit. Amit, there can be problems of lending from the banking sector, the corporate bond sector. As the alternatives champion here, do you see that emerging as a very big force? Plugging in the gap, because that's what Joydeep Sengupta's chart showed, that actually the intermediation is coming from private credit. Okay, private credit, but if you can speak both about alternatives and private credit, and what role do you see for them in improving credit for a 5 trillion economy?
No, I think I can go on and on about the role of private credit right now, but the industry has been growing, and as Joydeep mentioned, the disintermediation is happening in some sense, and that industry is growing very well. Private credit is an alternative to the normal banking lending, but if you see still a large part of India's corporate bonds, and typically private credit lends in form of bonds only. Still the 90% of bonds are AA rated and above, which are largely in the banking or the non-banking sector. The private credit only solves for flexible financing solutions, where there is some quasi-equity needs of the company, and actually it assists most in the growth of the businesses. And because there are companies which are growing at a very high pace, and sometimes it's become difficult to underwrite companies which are growing at 30%, 40%. And from a regular banking perspective, it could be too high growth, too risky a growth, where the private credit can actually jump in and support those growth hypotheses.
In particular, where do the alternatives come?
So alternatives, private credit is technically alternatives, but private alternatives are a compass of private equity, private credit, it could have venture debt, it could have a multitude of theses, it could have real assets. Like for example, now yielding assets have become a big market, right? Like we are buying out assets from developers, which could be roads, transmission lines, buildings, which are providing yield to our clients. So we are also giving exits to existing Indian corporates, which adds to their equity value. So if a corporate has already completed a road and it wants to construct a new road, it can sell its old road to funds like us, generate equity, and do the growth in terms of building a new road. So those avenues are all opening up because of private alternatives. And just Latha, I would like to add one interesting thing, because I've heard rupee depreciation a lot of time in this.
That was the next round of questions, yes.
Because I genuinely think it's dollar appreciation and not rupee depreciation. In fact, if you see from a currency point of view, rupee has still continued to do very well. This is a phenomenon of last 2-3 months. So from November onwards, only any sort of real depreciation has happened, which India would be approximately 2.93%.
3% in 2024. I have not calculated from Jan 1st.
No, I'm just saying for the whole year it was not there, because we track currencies quite closely.
I did the arithmetic for the year end, so
I'm just saying, if you see
and
from...
Importantly, what you say is very important, because that's exactly what the renminbi depreciated.
Yes.
So renminbi depreciated 3%, I mean 3.03.
So I just wanted to say that it is actually about the dollar appreciation, because euro has depreciated 5.5% in the last 3 months.
No, that doesn't matter. It really matters for the balance sheet manager, whether it is dollar appreciation or rupee depreciation. For us, it matters, because you have to multiply by 87 when you buy your next import. you can't multiply by
But
85.
it's not.
So it hits.
So again, I think it has got various impacts. But again, if all the world is going in one direction and US is going in one direction, you're not only importing from US, you're importing from other economies as well. So it's only then an exchange rate issue, right? It's not like if you're buying from China, it doesn't matter because your trade is happening in USD, but both the currencies have depreciated
I
at
take
the
your
same
point
level.
entirely. That's why I would keep saying that we have to look at the yuan depreciation.
No, I just wanted to add this because
Take your point.
No, I don't know why we take this rupee depreciation so personally. I mean, it's okay. It happens. I mean, all currencies across the world do
just
go
as an
up
aside,
and down. So
just as
it's
an
okay.
aside, I had done a small explainer on. I did it for Insta, assuming that audience for them just you only want to look at saying that depreciation is not bad. In fact, it is good because domestic industry will be protected from with expensive imports, so you don't get competition, and the exporters also will be competitive. But I got trolled. So, there is a lot of emotion attached to rupee. It is just the buying power of a currency. We don't look at it so neutrally. Somehow it is seen as national power, whereas actually depreciation is useful. But anyway, on that point, since geopolitics, our topic directly hits the currency, I just want your views on how do you all see the currency for 2025. What's your sense? Have we seen the peak of the dollar? And, should we be prepared for 88? Should we be prepared for 87? What may be the average? Since you all are the best experts, I can ask.
I think a simple thing is India inflation is at 3.5%, 4%.
India inflation?
4% CPI, 4.5% CPI. Let us say 5% CPI. I'm talking about the long term. So if you, big picture, you cannot run away from that if your inflation is, if you don't want your currency to depreciate at all, then you have to manage the inflation at international rates. It's like 2%. That's some time away. For growth, you need a bit of inflation. So it's not a bad thing. I think normally 2-3% expectation prediction, 3% gap year on year, that is a good thing. But as we move into next year, there are multiple things which are at play, right? One of the things which has got corrected with yesterday's statement of RBI, saying that volatility, right? We have made it close to zero, right? I mean, rupee volatility is the lowest in the world. And I've seen, and when I was working in the currency and all that, let's say 20 years back, 20%, 15% used to be normal implied volatility. Now it is at 3, right? Now, or 2. And the short term, it even goes to 1 and stuff like that. Now, the Reserve Bank has corrected it with yesterday's statement because over the last 1-2 years, we have suppressed the currency into such a small range. You always have a dam burst scenario at some point of time, right? The dam burst has happened after the new RBI governor has come and the new old gentleman has gone. You have got a dam burst scenario because one side, rupee will not appreciate. That's the view which people have taken. So people are only focused on when will the rupee depreciate, right? So the entire market scenario has got built on that. Now exporters should be selling. They don't want to sell because you are not going to ever have rupee. So one of the psychological part of the market is one segment. International scenario, last 3-4 months, once Trump comes, he will do tariff. And the fiscal side is going to increase his $5 trillion of extra deficit. The tax things he's going to put, additional tax he may do. All that thinking is all there. And over the last 2-3 months, that is a sort of play. Now, whether he will actually have the ability to do it, he doesn't have so many votes in the House. He's 218, 216, right? Yeah. So he cannot manage.
Mr. Govindan, your overall point is taken. If India's inflation is 3 percentage points above global inflation, which is 2%, then every year we will depreciate by 3%. And I did the average again for the year-ender shows. Last 5 years, average depreciation is 3%. So, if we started off at 86 or something, we should end at 88. I think we started off the year at 85 point change. 88 logically would be the 3%. I take your arithmetic point on that. I want a rapid fire on, do you think dollar index has peaked at 110? What is your, I just want your views on that. I want an average.
It is not peaked yet once the Trump being Trump.
So 115 is the peak?
Another 5% possibility maximum.
So 115 is not a bad guess.
Because some part of it has already come in already over the last 3 months. Maybe another 5% is possible and it will stop there. But what is important is what will happen to China, right? See, our problem is that China rupee, the yuan rupee is at 1165, 1170. That is very consistently is there. What happens if the damn thing goes to 8? Yuan, dollar yuan is what, 730, 735. If it goes to 8, 8.5, you will see pressure
no,
on
8 is very much in the market, so that does worry me.
8 and all that, you will see some movement here. So there are two things. One is international development and what happens to China. China is important for us.
That's a fair point. Just to, again, polish up our own memories, when the rupee fell 0.7 yesterday, it was the sharpest fall in 2 years, which means under the previous governor, one day it fell more than 0.7. You know, because we saw an immediate stability, we forget that he allowed volatility some time back. And we also forget that in one of the 5 years of the previous tenure, there was a 5% depreciation in the year. I think it was 2022, I'm not very sure. But, you know, we allowed volatility. We kind of give people a name going by the recency bias, which is very much there. But I thought this was a rapid fire. Rajiv, what's your, Rajiv Sabharwal, Rajiv Anand, what's your view on dollar and rupee?
I think, you know, given the fact that US 10 years at 480, that economy seems to be, you know, on fire at this point in time, we are going to see pressure in terms of flows,
stronger dollar.
And so therefore a stronger dollar is what one should be playing for. And so therefore, you know, we are in the 88 vicinity, you know, at this point in time. And I completely agree with Govindan as well. We certainly need to watch, given the situation that you're seeing in China and the weakness there, and weakness of the yuan will certainly, you know, play out for us. But I think, you know, more important than the dollar rupee is the impact the dollar rupee is having on local liquidity. And, you know, a few days ago we saw that liquidity, we were deficit liquidity of, you know, 250,000 crores. Banks are struggling to, you know, sort of generate deposits. Anyway, therefore credit growth has, you know, slowed. And so therefore, you know, as we think about an economy which is going to grow at, you know, 6.5%, add another 4% of inflation, 10 or 11% credit growth is just not good enough. And I think we've got to, and therefore for you to be able to generate 14-15% credit growth, yes, I mean, you know, the credit side will create deposits as well. But I think the question to ask is not, you know, I'm not so worried about whether the rupee goes to 87 or 88, but rather, you know, what are the mechanisms that we have in place to ease local liquidity such that, you know, the credit machinery, you know, starts to kick in again to a more meaningful number to be able to sustain a 6.5% growth.
Thank you and congratulations for outguessing my next set of questions, which was exactly that what will it mean to credit? Actually, that question to you, Rajiv Sabharwal. One, if you want to make a educated guess on dollar and rupee, but more importantly, what would the ask be from policymakers on liquidity? Or rates, I mean, both.
Actually, speaking, it's credit which drives growth. So I'm very clear, not the other way around. And it's very important for the credit to flow into the system. For the last, I would say, 1.5 years, the whole market, courtesy you, have been expecting rate cuts because you've been talking about rate cuts, but they have not happened. In fact, the reverse has happened. The reference rate of banks have moved up when everybody expected, and this has created a huge challenge in the market because the customers are really confused because they expected cuts, but they are actually seeing increases happening. So I think what is very important is, you know, ability to create more liquidity in the market. I think that will ensure that rates are coming down. Wonder whether we should be comfortable with a slightly higher inflation rate, but you know, believe that liquidity will help drive credit, will help drive growth, will help create jobs. That is going to be extremely important. And not only that, I think there are a lot of people who have leverage while the corporates might have reduced, but individual leverage has gone up, and their incomes may not have kept pace with the same. So consequently, they are also looking for an easing of interest rates. So I think more liquidity, which I believe will lead to the rest.
Okay. Rakesh, your thoughts? If you have a view on currency, which you have to since you are a lender, as well.
No, enough opinions have been given on that. So 2-3% is what we think. But clearly, I think as Rajiv was mentioning, the growth has to come back. And for that, I think the liquidity and also the interest rate. The interest rate has been elevated for some point in time. And I don't know when it starts coming down, whether next quarter. It's
a factor of liquidity.
Yeah, but it has to somewhere, because the affordability of the end consumer is also quite important from servicing the debt and living the life. So I think the interest rate cut is, and also to spur growth, I think that's also is important. So both liquidity and interest rate, which is needs to be addressed. What is the timing for that looks difficult at this point in time.
No, it's quite clear that, if liquidity is, the taps are opened, inflation may, come by. But perhaps what is needed is a mix of food inflation being controlled, because this is not a non-food inflation. It is very clearly a food inflation. And if that is controlled by not monetary measures, but it has to be done by fiscal measures. We've got 18 months of food inflation running at between 8 and 11%. It's not an interest rate product. So, the answers will have to lie elsewhere. Amit, any asks on this front? Or any guesses, and then, we are winding up with final suggestions.
No, I think 20-year rolling average for rupee has been 3.2 odd percent. So I don't think, and we have always had this situation of a sudden blip and then it just stable, and it's not one-time phenomena. It has always been like that. You do a sudden blip and then you are sort of stable for a long point. So I think that clearly is there. In terms of liquidity, I think there is also, if you look at the dollar flows, because of the US economy doing very well and the US 10-year treasury yield, as Rajiv said, being at 4.8, there will be the global dollar flow. US will be an attractive area for even the US, the global dollar flow. So the amount of inflows in India, and that's why you see some amount of FII selling in the markets, because they also want to maybe reallocate capital at various points of time. So yes, so it will be a liquidity constrained environment, but I think the growth will pick up because the government capex.
Even in the private market, this US exceptionalism play? It will only in the listed market?
No, it will be even in the private markets. It's not as visible or as, because that is more stabler. It's more long tenured money. It is closed-ended funds where money comes in for 8 years, 9 years. So it can't flow in and out so quickly. So those are a lot of stabler capital. Like we raise all 8-year funds. So if you've committed capital, you can't walk out of that capital. So it doesn't as much affect the private market, so to say, Latha. But the capex is about to come, because the government capex was also slow, largely because India was also going through a lot of elections. And I think genuinely the government capex will come in, and the private capex has always been a little bit of a tail thing after the government capex, so it will also start flowing in. So I see positive outcomes over the next 9-12 months, both on...
We can have a separate debate on elections and capex. I'm not quite convinced of the connection. There are other reasons why capex may have slowed. But actually that is, that was the next question.
Just, me and Rajiv were talking, it's how do we increase the disposable income available in the hands of the consumer? That is important. That can happen if the top line grows, his income grows, or his expenses go down, which means inflation goes down. So one of them has to work. For that, if we can create, more jobs or more value-adding jobs in India, that is going to be, and that should be our number one agenda as a country.
There is an economic policy framework also that is promised in the forthcoming budget. In the last announcement, I think in the July budget, the finance minister said that they are coming with an economic policy framework. So if there is a framework of higher incomes with a tolerance for higher inflation, I wouldn't be surprised if the framework gives us some clues.
And
Yeah, go
we
ahead.
can also learn, I mean, you spoke about American exceptionalism, but we can, also learn from them that, Trump is talking about the fact that he's going to cut taxes. But on the other side, there's Doge as well to get the government more efficient. That is a model that we should certainly adopt, where we reduce taxes, improve disposable incomes by making the government more efficient.
Well, actually, the size of the Indian government in terms of number of employees as a percentage of people is far less than the US. You'll be surprised. Probably they have more school teachers and doctors in their payroll. Probably we have more clerks. I mean, the quality is another issue, but I actually did the math once. We actually don't have big government. We are probably the wrong government. That may well be the case. But the last set of questions to you all is, what is your ask in terms of policy? We have both monetary policy but also a budget coming. Do you think this geopolitical issue should be addressed squarely in the budget and in accompanying policies so that we grab opportunities?
I think big picture, I would, the best thing to happen to India produces whatever goods and services which are required for India. Through that PLI, can a reasonable amount be produced in India? Number one. Number two, can the quality of goods and even the cost of goods through improvement productivity, that Gati Shakti, various things are there. But it is not yet, we have not yet seen it yet, the last mile.
We've not seen digitalization.
So once you have all of that, you will probably have a system where your Indian products and services, like it has happened in the automobile industry, right? Now Indian automobiles are spectacularly good. I think we can be proud of that. There's a lot of absorption of technology. It's happening here. So you need to have it in all around. So any framework which ensures manufacturing, because that will create jobs and incomes, and it creates can it be international quality products and services can be made in India for Indian consumption and for international consumption. I think that.
To be fair, the government has been pursuing exactly that. Electrification, providing cooking gas, providing, digitalization.
It's work in progress. It is not yet percolated down. That we'll have to complete that.
Okay.
Once we do that, I think even capex, I think the government's capability to spend capex is not there.
Okay.
12 lakh crores of.
Is there any ask in terms of grabbing the China opportunity? That's what I'm trying to say.
Yeah, that's the way you'll have to think. What can we produce goods significantly better than China? In fact, in some of the areas in which our own company, we are looking at, can I go down 30% below Chinese cost? It's possible if certain things happen, right?
Oh, excellent. I think that deserves a round of applause.
It's possible to do that.
If we can get that.
It is not that impossible. I think every company can do that. It is not, but some of the things have to come into play. Some things have come into play. I think it's important that, this cannot be a one-year problem.
The ultimate management of balance sheet is if you can be the lowest cost producer. There's nothing better than that. So I take your part of that. Amit,
I think
any ask in terms of how do you make the geopolitical challenge into a geopolitical opportunity?
No, since you asked about a question on what do you think will drive some of this growth. So growth needs credit. And industrial credit, as you saw, was growing lower. I think the confidence of banks in giving credit to those companies also is derived from the bankruptcy code, where the government has given a great job in the past years. I think the focus on the bankruptcy code to provide more creditor security, more creditor comfort, so that they can also do lending with a lot more strength. I think that is one thing which the government should continue to remain focused on strengthening the code and ensuring that the issues don't get...
Personally, my loudest applause is for what you are saying. Repeatedly in every banking question, in every IBC issue, this is where we are not getting it right. We need legal reforms. We need that commercial legal segment should be able to have foreclosures, should be able to have quick resolution. The Reserve Bank can only do an AQR and things like that because the legal system is not working. So legal reforms, you can say 10,000 times, the respect for the contract and the ensuring that contracts are implemented, stuck to. If we can get that, if the finance minister and the government in general can ensure that, the judiciary, everybody has to have a buy-in into that. You can't have the Supreme Court suddenly questioning an NCLT and, the entire auction process goes for a toss. I take 100%.
We have come a long way. I think we just continue to need to be on that path because we have seen a sea change in the last 10 years. I think the focus is required to continue for the next 10 years to make this.
I agree 100% except with the word sea change. Rakesh, your ask.
No, so Indian economy and financial sector has been quite resilient in the current geopolitical you are seeing
as an
the
MSME
war.
representative and lender,
Yeah, so
I particularly
think-
want to know if you think there are opportunities to grab.
The reforms has to continue in manufacturing. Look at the PLI, the way it has really helped the manufacturing.
So more PLIs would...
More PLIs, more focus on manufacturing, more job creation, and that will spur credit demand and growth. So I think that's a continuation. And China plus one, I think we need to really stand up and take the opportunity. I think...
yeah, China itself is looking for FDI so as to reroute. Rajiv, anything... Yeah, Rajiv, anything on those lines that you want from the geopolitical challenge should be met with geopolitical answers?
No, I'll come to the same point. How do we get more manufacturing in India? I think we need the next stage of reforms, whether it's land reforms, labor reforms, judicial reforms. We need that next, let's call these 5 years is a period of reforms where we take it to the next level and make India the easiest place to invest in. This will solve our job problem, our income problem, our dollar-rupee problem, so many problems it will solve. Just one issue. And we have so many states competing, so there is no challenge on competition. Some states have to stand up and say, we will take the lead in making our state the easiest place to invest in.
Right. Rajiv, last thoughts. Also as the Senior Vice President of...
First and foremost, thank you to all of you for being here. It's been a fantastic panel. As a banker, there's only one ask. I think, if all that plays out and growth happens in this country, there cannot be anything better as far as a banker is concerned. If new projects come up, we will do financing for them.
For CapEx.
More jobs happen, we will get salary accounts. So therefore, what we are asking for is more growth.
Well, it's for you all to deliver it. Thank you very much. I think this is brilliant that the panel could bring so much to bear and finish as the alarm rang. Thank you very much, gentlemen.
Hello. Thank you so much everyone for that insightful discussion. I request Mr. Abhiza Diwanji, founder, am I audible? Yeah. Mr. Abhiza Diwanji, founder, Neostat Advisors LLP and member BFSI committee to please present mementos to our esteemed panelists. We'll start with our moderator, Ms. Latha Venkatesh. Mr. Rajiv Anand. Mr. Rajiv Sabharwal. Mr. Rakesh Singh. Mr. Amit Agarwal. And Mr. R. Govindan. We'll have a group photo.